So the scenario that we had was have a client. They have both a business that operate out of a premises, as most businesses do. So they own this whole building partly in one shop that they're currently operating out of in their super fund, and then the other one they also own but in a trust. So the business currently is renting out shop one and paying rent to their super fund. So what they're wanting to do is that they did have another person in this other shop that was paying rent to their trust, but that person's that business is now gone. So they were looking to expand into the shop next door. So of course, in order to do that, there'd be a bit of construction or reno costs to do that. We'll knock down a wall and then to do the fit out in this shop. So, firstly, can someone tell me what sort of expenditure they would incur and what the tax treatment of that would be ordinarily?
I think it would be capital in nature, so improvements to the property.
Yep, so we'd have some capital works. Anything else that they might incur in getting this place ready for them to operate out of, other than capital works?
Yep. Costs to do the capital. So if they're reconstructing this building or knocking down the wall, they obviously have to get that checked. So is that what you're getting?
Or other than capital works, would there be anything else that might go in here that wouldn't classify as capital works?
Would there be legal costs for the new lease agreement set up?
Yes,
Yeah.
I'm heading more towards what physical stuff would be going in here.
Actual fit out.
Yep, and how's that treated for tax purposes, Steve? So if it's not capital works, what else might it be?
Depreciated.
Yep, that's right. So we have some capital works that would happen. And then there's also some depreciable assets. And well, from a tax perspective, it's going to be pretty slow getting a deduction for that, isn't it? Either by depreciation over however many years it might be, whether it's 15 to 20 years or capital works at the 2.5%. Can anyone see any options for getting a greater deduction than just the ordinary capital works and depreciation?
A lease incentive.
Whoa.
That's right, Steve, well done. And so it's pretty much like two options, and this is fairly new to me. I was entirely new to this whole lease incentive. Does anyone know what a lease incentive is?
Yes. It's an incentive that a landlord will give to a new tenant, so to encourage them to rent the property, usually by way of some benefit which isn't a direct, well, could be, but isn't normally a direct reduction of their rental fees.
Yeah, it can take a number of forms. It can be a rent-free period, it can be a holiday, it can be a number of things.
Good. So that was the option that we explored in this case, was the lease incentive. And there was one other option as well, with the fit-out costs, was also before I go into the lease incentive option, was also a lease option, was leasing the fit out costs. And what's the advantage of doing a lease?
Just paying the lease repayment.
Yes, that's right. So rather than just the small amounts of depreciation, you can claim the lease repayments. So that can be, say, over 5 years, and if you can get the principal down fairly low, and then you would sort of run that down fairly quickly, which ends up being better than just depreciating the assets. So with this lease incentive, what we're looking to do was for the landlord to provide these reno costs or renovation to the tenant, and how that works is that the landlord would get a deduction for providing that lease incentive. And does anyone know, could they provide the whole lot as a lease incentive? Or can anyone see what would happen if the landlord paid for these costs? So ignoring the whole lease incentive thing at the moment.
It would be a very slow deduction.
Yeah, so the landlord would just capitalise these themselves and be claiming it themselves. So the idea of the lease incentive is that they need to be provided to the tenant, so ownership needs to pass to the tenant. So that's how the landlord would get the deduction for it. And of course with capital works, if the landlord owns a building, they can't pass capital works to the tenant. So we're looking at just these depreciable assets, which hopefully, we haven't seen a breakup of the cost, but hopefully that would be the majority of the costs, or a good portion of the costs anyway. Then the flip side of it is, well, what's the tax consequences to the tenant? And there's a fair bit of case law around it, and what we need to make sure is that that lease incentive wasn't going to be assessable to the tenant. So the way around it was to make sure the tenant, the landlord is the one that pays for these. In the lease, ownership passes to the tenant as part of that lease incentive. It had to be in a way that is not a profit making, for a profit making purpose, which in this case it wouldn't be, because the tenant was wanting to move in there anyway. The tenant isn't doing it for the purpose of making a profit of gaining these depreciable assets, because they're essentially worthless. They wouldn't be able to sell them to anyone else. There's no receipt of cash by the tenant because the landlord's been paid for it. And then of course from a tax perspective, there's no effects to the tenants. They don't get depreciation on depreciable assets. And they have the right to remove these as well as part of evidencing the ownership and transfer of ownership.
Angela, there's no length rules around the lease agreement?
No, and I suppose it couldn't be too larger cost, like something that would be too unrealistic. The tax office would challenge something like that, like it was like millions of dollars for like a lease that's only worth, in this case it's about $30,000 to $40,000 a year. So just looking at it in perspective of the rent level is relevant. But we got advice from Richard Friend, and the cost of this was looking at about $100,000. Some of it would be capital works though. That the quantum isn't so important, or that wasn't really important in the cases that went to the courts. Do you have anything to add to that?
No. To put some numbers around it, so it's $100,000 all they're going to spend in total. let's say half of it, 50,000, is depreciable assets. So ordinarily, they would spend 50,000, like before doing it this way, they'd spend the 50,000 on depreciable assets and get to deduct that over, say, 10 years if it's cabinetry, sort of stuff, the modular bits and pieces. So instead of five grand a year, you get your tax saving on that, the depreciation for it. Whereas now we'll get 50 grand as a deduction straight off, which is not a bad result. So they spend the money today and get the money of the tax deduction today. So it's a good outcome.
Yeah, so that's the value that we added back behind.